Good hobbies around collecting vinyl. So there you go.
I know you a little bit better, Doug.
Proof we're all human right there.
Man.
Okay. Well, welcome everybody to Armanino's multi-state tax implications of a remote workforce. I guess we all got to know each other a little bit better with that initial conversation, but thank you all for being here today to join us. I'm going to quickly go over a few important reminders before we get started. To qualify for CPE credit with today's webinar, you need to actively respond to all polling questions and stay on for the duration of the broadcast. If you do have trouble seeing the polling questions, please submit your answers along with the date and time and name of the training to elevate@armaninollp.com. And we will be having a Q&A portion at the end of today's webinar. So please, throughout, if you have any questions, submit them via the chat and we will respond at the end of the webinar. And with that, I'm going to hand this off to Doug Sirota for introductions.
Hi, everybody. I'm sweating a little bit, but I'm glad you got to be up close and personal with my COVID hobbies. But appreciate everybody joining. I think this is a really salient topic. I have had a lot of my clients talk about the implications of COVID and what's going on with the pivot towards remote working and really kind of this changing the dynamic of how companies operate. And as all of us or as tax professionals know, that a lot of times will come with tax implications. So we're going to cover that on the call today. We're going to talk a little bit about the comp and benefits implications. Pete Klinger is a partner in our Bay Area practice, our national office, who's a comp and benefits partner. I've worked with him for many years, very knowledgeable in the area. We'll kind of cover some of the comp side of it, and then we're going to spend a fair amount of our time just talking about the state and local implications. And excited to have Darcy Quaker, who's a partner in our Seattle practice up here, focusing on the transactional side, sales tax, other types of taxes. And Kaylin Kleinams is senior manager in our Bay Area practice, focusing on the income tax side. So with that, I mean, quick plug on Armanino. I joined Armanino 2 years ago from EY to help set up the practice up here. Armanino is the fastest growing accounting firm, full service audit, tax, and consulting, mainly based in California, and we are rapidly growing in many geographies, including the Pacific Northwest, where we have a full service practice of about 60 folks here. So with that, I'm going to turn it over to Pete, and appreciate everybody attending. Thank you.
Yeah, thanks, Doug. Just before we get going here, I just saw a comment in the chat room that there's background music on. Doug, are you playing your vinyl right now?
No. Yeah, let me turn it down. No.
Alexa, is there music on still?
There is not, so I'm not hearing it. But
okay.
I think we should be good to go. Actually, before you dig in, Pete, we do have a polling question.
Yeah, go ahead.
Started. Okay.
I think that might have been a joke from somebody.
Okay, so for our first polling question, what percentage of your workforce should be remote? Less than 25%, 25 to 50%, more than 50%, or it depends? All right. We're getting close here. About 3/4 of you've answered. So we'll give you about 10, 15 more seconds to get those in. All right. Few stragglers. All right, I'm going to go ahead and close the polls in 3, 2, 1. And the correct answer is it depends. All right, so with that, we'll go ahead and dive on into the Pete section.
Yep. You can advance the slide, please. One more time. All right, so we'll talk about a couple different things here, but obviously a lot of companies have folks working remotely these days. mainly due to the lockdowns. But I think we've heard some companies announce that they're going to do this on a permanent basis. So what are some of the implications of that? And time permitting here, we can drill down a little bit on some of these things, but I'm going to keep it pretty high level. So first thing is state and local tax issues. So if you have employees that are now working remotely from their home, their parents' home, friends' houses, is that a new tax jurisdiction? Is it different than the one that they were working in when they were showing up in the office all the time? And so if that's the case, there's a number of states now that normally would tax folks once you come into the state and start working there, but have now suspended their rules for withholding due to the lockdowns. But that's not a large population of the states just yet. I think it's about 20 right now. On our website, I didn't put the link here, but we can send it out to you. On our website is a matrix that shows all the different states and what their rules are. It's very helpful. But start thinking about at what point do I need to start withholding tax from those folks. And in some states that haven't jumped on board with the suspension of these rules, that could be immediately from when those folks started working there. Separate from withholding taxes, there may also be other things like unemployment insurance that may be required by the company to pay into that state's unemployment insurance coffers, which would also include registering with the state, filing payroll tax returns at the state level, and then Darcy and Kayla, I know you're going to get into this, so I'm not going to go in detail here, but this can also create nexus issues at the state level that could require other things besides withholding tax and state unemployment. So think about those sorts of things. And then another question that comes up a lot is what about equity awards and other long-term incentives? So, salary is one thing where you're working in that state for the time you're there, you get paid your salary, and that may become subject to withholding. But if employees also get equity awards that are vesting over that time, but don't result in a tax liability until a later date. So think stock options that vested while folks were in these states, and then the lockdowns end, hopefully. They come back and now exercise their options. Should a chunk of that go to the state that they were in while the lockdown was on? And a lot of states have rules around this. And generally speaking, that is a requirement to allocate a portion to those states. And it's not just equity awards, it can be other long-term incentives. So think annual bonus plans where someone was, for 6 months or more in a different state earning those bonuses, and then it was paid when they came back. There may be a requirement there as well to allocate that to other states. So we've had lots and lots of discussions with companies around this in terms of, what's the thinking here? What's the plan going forward? And I guess it boils down to, should you let your employees work from wherever they want to? Next slide, please. So here's some things to think about along those lines. So there are substantial costs that are associated with mobile workers where they're working in places that the company doesn't otherwise have a location or other employees. So first things to think about is, well, how do we know where they are? How do we track the whereabouts of our employees? And I've heard from lots of companies that they get surprised that, well, hey, our employee told us today that they've been in, Hawaii for 3 weeks, but we didn't have any idea. So is there some sort of tracking mechanism? Is it the employer's responsibility or the employee's responsibility to report back on this? For example, we at Armanino, we all file timesheets every day that also asks what your location was for that day. But I wouldn't impose that on my enemies. It's a brutal kind of thing to do, especially if your culture is not used to that. So, think about how that gets done, and there's not really an easy answer to that. What about HR policies? What are you telling your employees? Should they go out and just go wherever they want and move around? Is that okay with the company? Is there any communication to them whatsoever? And now, should you be limiting those locations to help reduce costs and complexity? Should you tell your employees, well, hey, you can't work in this state because it's too expensive for us to comply with all the tax laws there? What about things like cost of living adjustments? So I'm in the Bay Area. If you're in the Bay Area, you know it's very, very expensive here. You know, what if I decide to go to Montana for a few months and work there? What if I decide to stay there? Should there be an adjustment for cost of living? In that case, a decrease. And that can work the other way as well. Particular for Washington, because obviously there's no income tax there, folks are going to states where there is an income tax and incurring those extra expenses. Do you do anything to help them with that? Should there be an adjustment, an upward adjustment in this case, for the fact that they're now paying state tax when they weren't before? And then finally, what happens after the lockdowns? Assuming that happens at some point soon, we hope. But you know, should you continue the same policy? As I mentioned, other companies are doing right now. Is that the way to go? And if so, you know, what are the issues around that? Things we just addressed. And then what about expenses related to working from home? So we get a lot of questions on this one as well. Next slide, please. So you probably, if you're like the other companies I've talked to, you've probably set up your employees with computers, monitors, keyboards, Wi-Fi, printers, desks, chairs, et cetera, et cetera, et cetera. Can you deduct those expenses? Do they have to be imputed income to employees? And generally speaking, most of the expenses I just mentioned would be considered ordinary and necessary expenses. But remember that you have to have this set up under an accountable plan, which means, you know, a policy in writing that says, here's what we do, and requires substantiation of those expenses. Generally speaking, that would be permitted. Remember that certain types of I'd say the more common expenses that I hear companies paying for now are cell phones, computer peripheral equipment, Wi-Fi, that sort of thing. Generally, those are not what we call listed property, meaning that the substantiation is simply, here's an invoice from my provider, and I don't have to go through and itemize. Remember the old days when we had to itemize our cell phone calls and say which one were business and which one were personal. So that's not a requirement there anymore. And then I'm hearing some chatter about Section 139 disaster relief in lieu of an accountable plan. So remember that the pandemic was declared a national disaster by the president, which invoked Section 139, which allows companies to make payments to employees and other folks that would generally be considered non-taxable to them for things like payments related to disasters. And of course, the question here is, you know, are the working from home expenses that we just talked about, are they really disaster relief payments? And I suspect the answer to that is no. And you know, the question then is, well, why take the risk of doing that when you can do it through an accountable plan? Then that's fine. 139 doesn't provide any substantiation requirements. If you fail to substantiate and later it's kicked out of 139, you're not going to be able to take those expenses under an accountable plan, and it's going to be imputed income to employees. So I think pretty hard about whether that's doable or not. Next slide, please. And then this is kind of a tangential issue at the moment, we hope, but remember that if folks start traveling again, I know some folks are already, but if folks are moving around now for business purposes, then the question becomes, is that considered travel away from home? Now this is a long history in the tax code for what this concept of tax home is. It's not what it sounds like. So your tax home is the place where you normally do business. It can be an employee's residence if that's where they normally do business, but generally speaking, it's their office location or where they most frequently work. And when you're traveling away from home on business on an overnight trip, the expenses related to travel, food, lodging, et cetera, are deductible as business expenses and not included as part of the employee's compensation. And so how do I know where my tax home is now? Since I've been working from home for so long, does that change my tax home? And there's generally a bright line test here where if it's expected that the move, the working from home, would last more than a year from the outset, then generally that would be considered your new tax home. I haven't heard from anyone that that's really been the case, that there was an expectation up front, except now, as I mentioned, some companies have said, well, you now are permanently working from home. Well, that would move your tax home from your prior office location to now your residence. And so going to the office may become a deductible expense if it's not frequent, but also traveling from your home to other locations to visit clients and other business reasons may also now become a deductible expense under the travel away from home rules. So something to think about there as well. And I think that's it, right? Yeah. So I'll turn it over to Darcy and Kaylin. Thank you.
Great job, Pete. Thank you. That's wonderful and scary at the same time. So this is Darcy Quaker. I'm here with my cohort, Kaylin Kleinhaus, and we're going to be talking about Washington and Oregon, specifically business taxes and how those are affected by employees moving around. So next slide, please. Very good. So jumping right into this, whenever you're dealing with a state and local tax issue, business tax issue, you always start with nexus. Because nexus is the connection between the taxing jurisdiction and a business. And if you have enough nexus, then the taxing jurisdiction can subject the business to its taxes. And I like to equate nexus with a disease. There's so many similarities here in the analogy where you may be kind of feeling a little uncomfortable. You're not quite sure. Maybe I have something, maybe I don't know. And the way to figure it out is to get a diagnosis. You need a nexus study to figure out if you have nexus. There are also different types of nexus that you could have. There is a physical nexus, which typically involves having an employee or inventory or even third-party representatives in a jurisdiction that is representing your business. So those are the types of things that can create physical nexus. And then we have also now economic nexus. Economic nexus is generally defined as where a business is selling $100,000 of goods or services into a jurisdiction in a calendar year. Generally, all states like to do different things, but in general, that's the definition most states have adopted for economic nexus, with the exception of California, Texas, and New York that have thankfully adopted a higher standard of $500,000 of annual receipts before an economic nexus is imposed. Economic nexus is relatively new due to the Wayfair case that was decided in June 2018, where the South Dakota really set up the scenario, took it to the Supreme Court and said, you know, physical presence nexus in this digital day and age is kind of antiquated. We think there needs to be an additional standard that will allow us to impose taxes. And they did. So we now also have economic nexus to contend with, and we're going to spend a lot of time talking about these nexus standards.
Yeah.
Just really quickly, as Pete mentioned, with the other types of nexus, for these purposes, there can also be trailing nexus, where you may end your nexus technically, but then it kind of lingers on for maybe another year or so. So kind of like a disease, you're never quite done with it. It just kind of lingers around a little bit. So that's nexus. Kaylin?
Yeah, and so, you know, as Dar said, she mentioned the $100,000 of annual sales. That is pretty much the standard from a sales tax perspective. Sales tax, because the Wayfair case was a sales tax case, sales tax has really, all the states have gotten on board with getting a threshold defined. I think there's probably a few that still haven't, working on it, but it's just a matter of time. So sales tax, it's both physical and economic in many of the jurisdictions. However, for income taxes, it's where it becomes a little bit more gray. So there's always physical nexus, that's pretty standard. But where economic nexus for income taxes and even business activity taxes is that there may not be a standard, a bright line threshold defined in the state. They may just say that you derive business income from customers in the state and not define what that dollar amount is or the level of activity. And so they leave it kind of in this gray void where, you know, taxpayers are left to go, well, what does that mean for me? Is it 100,000 like sales tax? Is it 500,000 like some of the other jurisdictions? Or in the case of New York, for income tax purposes, $1 million. So even from a sales tax versus an income tax perspective, some of these states have set different thresholds and said, well, for sales tax, New York is 100,000, but for income tax, it's $1 million. So that's where, you know, it really is, you know, constantly moving, changing. Wayfair definitely changed the landscape for both income and sales tax. And as Darcy said, you know, it is important that, you know, studies are done because it is forever evolving, and making sure that you're staying on top of it is really key to making sure that you're staying compliant.
Excellent. Next slide, please. Okay, so we started with Nexus. Now we're going to talk about the Washington taxes that could be impacted by employees moving around. So the first one is the Washington Combined Excise Tax, which we all know and love as the B&O tax, business and occupation tax. It's a gross receipts-based tax, and Washington also obviously has sales and use taxes. As we mentioned, Washington adopts both the physical and economic nexus standards, and Washington's current nexus standards, they've changed it several times over the last couple of years, is now $100,000 in annual sales. The next tax we're going to be talking about are city business and occupation taxes. So like the state, cities also have gross receipts taxes. There are 42 cities in Washington that have their own independent business and occupation taxes, kind of like home rule sales tax states, if you will. And notably, these 42 jurisdictions with these taxes are all on the west side of the Cascade Curtain, so you don't have to worry about Kennewick or Spokane or Yakima. It's all on the west side. The nexus standard for the cities is physical nexus still. I just confirmed that with the city of Seattle this morning because there was something out there that made it look like maybe they were starting to adopt economic nexus, but no, they're still at physical nexus, so that's good. And the one thing that we need to be concerned about with the city taxes is that if you have service revenue or revenue classified as a service for city B&O tax purposes, their apportionment methodology is a two-factor apportionment calculation involving payroll. And the payroll factor is Seattle-based payroll, or Seattle-based in the case of Seattle, over total payroll. So we'll be talking about that and the impact of employees moving around on the payroll factor. Finally, the other one we want to talk about is Seattle's new payroll expense tax. This is a big topic of interest. We all know that Seattle passed what, air quote, the Amazon tax. They're trying to tax high paid employees, but the tax is imposed upon the business, the employer, and the base of the tax is the payroll expense of employees that are primarily assigned within Seattle. And the nexus standard for this tax is physical, where the employees are. It becomes effective on January 1, 2021, so not yet. Payments are due quarterly or annually, so start thinking about that. It applies if your company's compensation expense is exceeding $7 million annually, and also it applies to employee salaries that exceed $150,000 per year. The trick here is that it is imposed if the employee is, quote, primarily assigned, end quote, within Seattle. And so we're going to spend a lot of time talking about what primarily assigned is. The definition in the Seattle Code says that primarily assigned means the business location of the taxpayer where the employee performs their duties. That is critical. About a month ago or so, the city of Seattle called me and said, hey, Darcy, we're having a stakeholder group and we want you to sit in on this because we need to write a regulation about this new payroll tax and we need help. So I sat in on their first stakeholder meeting a week or so ago, and we were talking about these definitions and trying to figure out what they mean, which is really fun being at the table and hearing these conversations. Because the city attorney, Kent Johnson, was just musing out loud, and he said, well, I think primarily assigned might mean, you know, if somebody's working from home 1 day a week, they're still probably primarily assigned to the office. But he does view primarily assigned as being the place where the person is physically present and performing their work.
Hey, Darcy, this is Pete. That sounds an awful lot like the definition of tax home I just covered for federal tax purposes. Did that come up at all?
No, it did not. Seattle pulled this the city council pulled this definition from the business and occupation tax for the cities where they use this definition, and so they probably the B&O tax probably got pulled from someplace else. These taxes are very incestuous, I guess, where something looks good in another jurisdiction for another type of tax, and you just grab that definition and use it. But then once you start sitting around the table trying to figure out how to apply it, that's when things start to fall apart. And that's what Kent Johnson was saying is, yeah, we've never had a problem with this primarily assigned definition for B&O taxes, but now with COVID, it's all kind of a big mess because people are moving around all over the place. And do we know where they are physically present or how much physically present do they need to have? So it's still in flux right now. And I'll talk about that on in a little bit more depth about what I think it might mean. Finally, one other that I didn't have space on the slide for, don't forget the city of Bellevue also has a square footage tax based upon the square footage of the office space if you don't have sufficient B&O tax from your activities, because Bellevue is a really nice place to be and corporate headquarters like to locate there. There's only been one riot in Bellevue as compared to Seattle, so people like Armanino and others are moving to Bellevue, but there is also a square footage tax that can be imposed there. Finally, one final tip for cities: when you're dealing with city taxes, make sure you're actually within the city before you start paying taxes to the city. There are areas down in South Seattle, SoDo, that like to call themselves different things as compared to, in not Seattle, and especially down in the Tukwila area. You may be in Seattle or you may not be in Seattle, but your address may be Seattle. And it would be horrible to pay taxes to Seattle if you're not actually within their jurisdiction. So do a little due diligence and check some maps. Okay, that's Washington. Moving on to Oregon.
All right, thanks, Darcy. So Oregon, similar to Washington, has lots of different levels of taxes. So we'll start with, Oregon's corporate excise tax, it is an income tax, even though they say excise, which generally means some other type of tax, but it is income tax. And the Nexus standard for that is both physical and economic. And then we also have Oregon's new corporate activity tax, which its name is a misnomer. It is applicable to all entity types. So C Corp, S Corps, joint ventures, partnerships, trusts, and estates. So don't let the name fool you. It's a modified gross receipts tax, meaning that the starting point is gross receipts, but they do allow for certain subtractions from gross receipts. They're still working out the regulations and rules on this tax. It is effective 1/1/21. And right now, though, estimated tax payments are required to be made this year if you meet the economic nexus standard, which is $750,000 of Oregon commercial activity. So that is Oregon directed revenue, or revenue from Oregon sources, depending on what your industry is. We also have the Multnomah County Business Income Tax and Portland Business License Tax, which are filed on one form together. So it's covering 2 areas, one form. It's an income tax on businesses. It also has a physical and economic nexus standard. And then we have Portland's metro area, which is a new homelessness tax. And the Portland metro area actually includes 3 different counties. So it's Multnomah, Clackamas, and Washington counties. So, and don't let the name fool you, it's not just Portland. It is a income tax both on individuals and businesses. And for individuals, it's residents and non-residents. It's really based on where the revenue is derived from. So for individuals receiving their wages from a Portland office, that would be considered Portland's that income would be subject to the income tax of Portland's metro homelessness tax. So it is an economic standard, and so it doesn't matter where the individual is. As I said, it's both resident and non-resident. So they're starting to expand their list of taxes. Next slide.
And a polling question.
Yes, brings us to our next polling question. Okay. So for our second question, we have Oregon CAT applies to the following entity types: CNS Corps, joint ventures, partnerships, trusts and estates, and all of the above. All right, we're about halfway there. I'll give you guys about 5-10 more seconds to get your answers in. Just about 10 left to go. All right, we'll go ahead and close the polls in 3, 2, 1. And the correct answer was all of the above. Looks like most of you got it. Some thought CNS Corps was the answer. Okay.
All right, so Darcy and I, we put together some scenarios to help connect all this facts and different types of taxes and the fact that employees are moving around. So we're going to start with scenario 1, which is the Seattle employee temporarily shelters in Portland during COVID. So our facts are that the employee newly lives in Seattle, Washington, and prior to the pandemic worked at the company's office location in Seattle. The employees are currently required to work from home as the Seattle office is closed through the end of the year. Also, we added this caveat, as Pete mentioned, tracking where your employees are. So we said that currently the company is not confirming where employees are working from during the pandemic, nor do they intend to post-pandemic. The company continues to maintain an office in Seattle, Washington, and anticipates most employees coming back to the office post-pandemic. The company performs consulting service and also sells SaaS via the cloud, and is C Corp, with the employee making $175,000 per year. Next slide.
Okay, so given those facts with this scenario, and actually I know of somebody who did just that. When the pandemic hit in March, they packed up, moved down to Portland. So what are the business tax, Washington business tax implications for the business? Well, number one, for the B&O tax and sales tax, no impact. The company already has Nexus, so no change. For the Seattle business and occupation tax, recalling our facts that the company is selling services, and those consulting services are apportioned under using Seattle's 2-factor payroll formula, including payroll and sales. So the numerator of the calculation of Seattle-based payroll again, like I mentioned earlier, they use that definition of where is the person primarily assigned to determine if the person's salary expense is included in the numerator. Now, the definition in the Seattle Tax Code for primarily assigned is listed down below. It's where the business location of the taxpayer, where the employee performs their duties. And that looks kind of awkward, but I broke it up in that way to really emphasize that there's two criteria here. You have a business location of the taxpayer, where the employee performs their duties. So here, if you know that the employee is not in Seattle, even though our facts said we're not tracking where our employees are actually at, the employee being located in Portland would not be primarily assigned to Seattle, perhaps. So it's possible that you could exclude that employee's payroll expense from the numerator for calculating the service B&O tax. But again, I'm kind of muddying the waters where we're assuming at this point we don't know. So if you don't know where the employee is, at that point they probably still are primarily assigned to Seattle, and their expense would be in the numerator for purposes of calculating the B&O tax, which when you run all the calculations, that makes your tax go up. So employee in Seattle, more tax. Now, the implications for the Seattle's new payroll expense tax. No impact because the tax doesn't start until 2021. And so for now, we're okay with everything as is, no change. Okay, next.
So now that a Seattle employee is in Portland, what are the Oregon tax implications of that employee now being in Portland, Oregon? So from an Oregon corporate excise tax perspective, Oregon has provided nexus relief for teleworking employees, but only between March 8th and November 1st of this year. So it doesn't even go through until the end of the year. And you know, in talking with clients, a lot of offices close through the end of the year. So unless Oregon expands that protection, there could be nexus if the employee stays past November 1st for the Oregon excise tax purposes. For Oregon's new corporate activity tax, there's no impact as it's really based on the Oregon sourced gross receipts. So the employee doesn't change whether there's nexus for the Oregon CAT. It's just really based on still where you're sourcing for gross receipts. For the Multnomah County and Portland business license tax, there is no code relief, and so the employee would create nexus in the county and city. So now that employee could be creating nexus both in Seattle and in Portland, which is really unique and very much, you know, double tax. The Portland Metro homelessness tax, it would be no impact if the employee doesn't stay past 12/31, as this tax is effective 2021. Oh, sorry, doesn't stay past 2020, as it's effective 2021. Slide.
Okay, so that's the scenario of someone moving from Washington to Oregon. Now let's flip it around and just say that the business is based in Portland, Oregon. The employee decides to shelter in place in Seattle. And I take full credit for the artistic inability of the little diagram down there, but I like pictures, and it just kind of helps envision what we're trying to explain. So next slide. Okay, so now we've got a Portland-based employee coming into Washington. What does that do to Washington taxes? Number one, if the Portland, Oregon-based company never had nexus before, well, we've got an employee working in Washington. Does that create nexus? We know the definition of physical nexus is having an employee, but we're in COVID times. And I'm an advisor to the Washington Department of Revenue, and we had a business council meeting a couple weeks ago, and I asked the department about this. I said, are you guys going to publish anything about physical nexus? And their response was, be careful of what you ask for, Darcy. We're just going to lie low and not say anything. But it is the executive said it is their intention that, you know, this type of short-term physical nexus due to COVID will not create a nexus for tax purposes. And that's oral information, but that's their position here. Other states are coming out with more definitive information. I've got a list later on, but most of the states are just kind of remaining mum on the issue, which is a little concerning that they might come back and get you. But at the same time, this is COVID times, and they're generally being somewhat understanding of the situation. Okay, the next one, Seattle's business and occupation tax. No guidance on if an employee working from home in Seattle creates nexus. Kind of the same thing. So I think it's unclear, but like Washington, I suspect that the city of Seattle, the other cities are going to say, you know, this is just temporary. The person's really not market facing up here. They're just working from home, sheltering in place. So it's likely that the cities will not consider a physical presence being created. If you're really concerned, if you have this scenario, you might just want to write in, get a little written ruling from them to protect yourself and throw it in the files. But I think at this point that it's probably not going to trigger nexus. Finally, the Seattle new payroll expense, again, no impact because we don't have to worry about that until 2021. There was a question that came in about the Seattle payroll expense and how there is a $7 million payroll threshold for employers before they are subject to this tax. And how is that $7 million measured? Well, that's a fantastic question, and at the same time, the City of Seattle Finance Department is still trying to figure all this out. I believe that they are going to interpret the $7 million threshold as a calendar year test for determining the $7 million. But more to come on that as we sit around the table and talk about how these things will be ultimately decided in regulations. Next slide.
Yeah, so now that we've had a Portland employee, you know, temporarily go to Seattle, what does that mean from an Oregon standpoint? So from an Oregon's corporate excise tax, it's complicated. Oregon may still consider the Portland employee to be working within Oregon, while the employee views themselves as now a Washington employee. It really depends on, you know, as Seattle is giving breaks, there is no kind of reverse guidance of, you know, Oregon will give breaks to people who come into Oregon. There's no guidance on if an employee leaves, are they still considered Oregon, or are they now transferred to that state that they moved to? So it is unknown if Oregon will allow that employee to be excluded when considering excise tax nexus. I think currently kind of the assumption is that, you know, if you're getting relief from that person moving to a state with relief, that, you know, they're probably still been considered an employee in their state that they originally based. For the new CAT tax, there's no impact. As I said, it is based on your gross receipts. So again, you're looking at gross receipts and not physical presence. For Multnomah and Portland, there is no guidance available. However, it could be beneficial for the company to consider the Portland employee as being outside the city and county. So if you know that that employee has left and that was your only employee in that county and Portland, then would you have nexus anymore? So that could be very tax beneficial. And then for the new homelessness tax impact, as the company is retaining the Portland office. So you would still need to evaluate the income tax and overall gross receipts to determine the taxability for that tax. Next slide.
Okay, so now we're moving on. And this, now we're saying that the scenario changes slightly, that we're somewhere down the road into post-COVID period, and that's in parentheses because we don't know when post-COVID is going to be. Most likely, the way things are looking, it's definitely not going to be in 2020, but maybe sometime in 2021. Let's hope. What happens then once things are more settled? And in our next scenario, again, the Washington-based business, Seattle-based business has an employee temporarily working from Portland, but then they decide they're going to settle in Portland. They like it down there. So now what happens to the taxes for the employer? Next slide, please. Okay, Washington B&O tax, no impact. Seattle's business and occupation tax, again, we look to that primarily assigned definition. Employee in Portland is most likely not primarily assigned in Seattle, so you can exclude the payroll expense from the numerator of the payroll factor of the apportionment calculation. And the Seattle payroll expense, that employee is not working in Seattle, so that employee's salary is not subject to the payroll expense. That's probably about the happiest slide that we've got in this whole deck. Next slide.
That's for sure. Yeah, so for Oregon, the impact would be that because the employee is staying post the stated nexus relief for the corporate excise tax, that, and I put in quotes, Seattle employee who's no longer a Seattle employee, they are now an Oregon employee and would create Oregon excise tax nexus for the company. For CAT tax, again, no impact. Multnomah and Portland, they would create nexus in the city and the county now that they are officially in Portland. And then for the metro area homelessness tax, again, assume that they're staying when the tax is effective, so 1/1 the business would need to consider the income tax and overall gross receipts tax to determine the taxability, as well as that employee would need to consider their taxability, the income tax on the individual as well. So both business and income tax implication with that one. Next slide.
Okay, so last scenario here. So again, we're flipping it around. Portland-based employee moves to Seattle, stays in Seattle, and so now what happens to the Portland-based businesses' taxes? Next slide. Okay, for Washington, it created with that employee being up here long-term post-COVID, whatever that means, the Portland-based business has created physical nexus in Washington and is now subject to paying Washington B&O tax, sales tax on its sales to customers in Washington state. Here's an interesting one. So presuming, like Pete said, that the employee is bringing with him or her a laptop, a monitor, an ergonomic chair, whatever you may have, well, Oregon doesn't have a sales tax. So most likely all of those goods were not subject to tax when the company bought them in Oregon, but when the employee now brings them as business personal property into Washington, I think we've got a tax. I think we've got a use tax on the value of the item brought into Washington, as well as a business personal property tax that needs to be reported. So that's not fun, but don't overlook that. You know, a laptop here or there may not be material, but if you've got lots of people that are moving around from Oregon into Washington, it could be material. Also the Seattle B&O tax, again, we've created physical nexus. The employee is permanently up here, so the employee's payroll expense should be in the numerator of the payroll factor for apportionment purposes. And also now we get to pay the Seattle new payroll expense. because the employee's salary is, in our example, $175,000, which exceeds the employee salary threshold of $150,000. And so therefore, we're going, this employee's payroll is going to be subject to the tax. Next slide.
Yeah, so now we have the Oregon side. So for the Oregon's corporate excise tax, now that a Portland employee has moved outside of Oregon, did it change your nexus? It's looking at not just that one employee, but the whole company's profile. Do you have, offices there? Do you have other people there? Other employees who haven't moved? Did that employee actually change their residency yet? Are they still considering themselves Portland or, specifically Oregon resident? So there is considerations there, especially, not so much on the business side, but again, the payroll tax side of things, right? So if that employee, no longer wants to have taxes withheld for the state, that they were in versus the state that they're moving to, that creates other complications. So then we also have Oregon's CAT tax, no impact again. So as you can see, the CAT tax really is derived from Oregon source gross receipts. So it is really important that you're understanding where your gross receipts are being derived from, not so much where your people are or where your office is. For Multnomah and Portland, it's again complicated depending on when they change the residency. It could be beneficial for the company to consider that Portland employee now being outside the city and county. Again, if you're not tracking your people, when can you make that decision? Versus if you are kind of staying more on top of when they're moving and what they're communicating to you about the fact that they're deciding to stay, then that can support a decision to no longer have nexus in these jurisdictions. For the homelessness tax, again, because the company in our example is retaining the Portland office, the company would still need to evaluate income tax and overall gross receipts to determine taxability. Now, that individual who moved to Seattle, if they're still receiving their income from the Portland office, they could be considered a non-resident receiving Portland income and therefore be subject to homelessness tax as a non-resident. So just because they moved doesn't mean that they're not going to be subject to that tax. So as you can see, it gets quite complicated, especially in this new tax, which they're still, defining and providing guidance on. So we don't know everything yet on this one.
Very
Next
good.
slide.
This is Darcy. Yeah, there's a lot we don't know, including going back to the city of Seattle taxes. Recall, especially for the payroll tax, that it's the tax is based upon the employee payroll expense. But the tax is going to be due starting in 2021, payable on a quarterly basis. So what if your employee moves between states somewhere during the calendar year? Most employees are not going to make a nice transition on January 1 for purposes of your payroll expense calculations. So that was a big topic of discussion in the city of Seattle stakeholder meeting is, oh boy, now we have to probably deal with apportioning or divvying up the payroll expense for the employee for what they earned, where they were. So more complications and challenges to work with. Next.
All right, next we're going to do our third polling question. Okay, so this one's kind of easy if you're paying attention. How many examples were reviewed so far during this presentation? 1, 2, 3, or 4? All right, answers are coming in. 3/4 of the way there. We'll give you about 5 more seconds. Okay, I'm gonna close the polls in 3, 2, 1. All right, and we shared 4 examples during that back and forth with Darcy and Kaylin. So, okay. Let's move forward on your summary.
All right. So, company considerations. It is important that there is some sort of policy in place for monitoring employee locations now and, in quotes, post-COVID, since we don't know when that is. There are different ways to monitor. There is, I've been talking to a lot of clients, and there's pushback sometimes from employees going, well, at what level are you monitoring me? Is it when I turn on my computer? Is it the IP address? Is it just self-reporting when I'm saying, hey, I'm going to temporarily shelter in place in Florida, and then I change my mind and I communicate that to you? So it is, different policies can work for different companies and your employee culture. It is important to consider temporary work from home havens that have provided some guidance, as not all states have addressed the COVID pandemic and what that means for teleworking employees, but DC, Indiana, Massachusetts. Oh, go ahead.
Oh yeah, I was just going to jump in here because this is primarily related to sales tax, where I found this list where these states came out specifically saying, hey, telecommuting, working from home, we're not going to consider that to be a physical nexus. So at least we have these states publicly stating something. The others are mum.
Right.
Go ahead, Kim.
And a lot of them, the states that have, and from an income tax side of things that have provided guidance, a lot of them haven't defined what that time period is. They've just said during the pandemic or the crisis. And so we don't know what that means to them. Is it when their state chooses to lift it? Is it when the national order is lifted that it's no longer, a crisis? So we just don't really know what that looks like. But it is important to have the company policy for post-COVID employee locations of setting a policy that makes sense for the company, both from a sales tax nexus perspective, income tax, payroll withholding, as Pete said, the unemployment side of things. There can be a lot of implications when employee locations that were limited to 1 to 2 states have now scattered to 10 plus states. That can be a lot of extra costs of compliance and monitoring the proper policies that need to be in place for the company. And then, setting general policies like anybody can work from home anywhere, or you can work from home only allowed in certain states where the company already knows that they have nexus. So you're limiting employees to states that you're already aware of what the implications are, and it's not going to be new states. Or requiring people to return to office locations after the pandemic. So there's multiple policies that can work for your company.
Sometimes it's good to know for tax purposes where people are, and sometimes maybe you just don't want to know. So that's a consideration. Do you want to document it where people are at? So a lot of questions at this point. Moving on, consider your business property location. So again, we talked about, well, if we're moving business personal property from one state to another, we might have use tax. We might have business personal property taxes. Also, this one was kind of interesting, and I know one of you on the phone has this issue. If employees are moving around, does that impact Washington's multiple points of use sales tax exemption and the factors that have been created to determine that exemption? So think about that. And if you don't know what the multiple points of use exemption is in Washington, shoot us an email. I'd love to chat with you about it because it's a good one. Okay, other things to be concerned about. Are there going to be more new taxes? Well, I think I'm predicting a perfect storm here, perhaps, with number 1, COVID and states needing money. Number 2, a whole bunch of auditors sitting around with not a lot to do because they can't really do a whole lot of auditing. Number 3, should the presidential election go in favor of the Democrats that generally tend to like more taxes, it's almost the perfect storm where when the legislatures convene in January 2021, there might be more taxes. Specifically here in Washington, you always hear rumblings about an income tax, and Representative Noel Frame is very, very adamant that Washington needs an income tax, and she has a study group to study what would Washington income tax look like, except the study group is taking on more of a bend of how to impose an income tax. I was sitting in one of her meetings, and she said, oh, we'll just ask the Department of Revenue in Washington how to do this. And I said, Representative Frame, nobody at the Department of Revenue understands income tax. We're B&O tax, sales tax people. She said, oh. So nonetheless, 2 months later, the Washington Department of Revenue went out and hired some income tax people. So be afraid, it could be coming that Washington may have a corporate income tax in the near future. Kaylin, did you want to talk about other taxes as well?
Yeah, what I was going to say was that, just like, there might be state tax changes, there's also localities that are really struggling right now. San Francisco, I believe, said lost $1 billion+ because of COVID. And so local jurisdictions will also start looking for ways to increase their tax revenues and make up for lost revenues during COVID. So it could be more local taxes that we're seeing, or a shift from an income tax to a gross receipts tax. Again, trying to go after the revenues, even if the company's in a loss position, is, something that a lot of local jurisdictions are considering. And so gross receipts taxes are definitely becoming more common, especially on the local level. So again, don't just assume that if you're in a loss, that from a net income tax perspective, that you won't have taxes. And also watch where you are locally. What cities are you in? What counties are are people in? As that can, again, exponentially increase your tax compliance.
Thanks, Kaylin. I mean, I think we're coming up to 12 o'clock, so I think we got to wrap this up. Should we do the last polling question, and then we can cover a couple questions after that?
Yes, let's do that. Okay, for our final polling question, local jurisdictions look for ways to increase city revenue via gross receipts taxes, payroll taxes, value-added tax, or A and B.
And while you're answering that, this is Darcy. I'll just jump in that while Kaylin and I have focused this presentation primarily on Washington and Oregon taxes, we are deep in all other states' taxes. So we here at Armanino, if you've got questions about other taxes, reach out to us. Let us know in other states.
Yeah, I mean, we've had questions about if there's any kind of prepackaged offering where you look at all the different taxes, different things about registration, and kind of assessing this. I mean, I think while we don't have anything prepackaged, our state and local group plus our business outsourcing group, which looks at registrations and other types of insurance, and is fully equipped on a multi-state basis. And a lot of my clients, especially in the tech side, are actually going to let leases run out and go to full-time remote, and are evaluating that, and we're kind of helping that. So we can kind of custom tailor something for you guys, or have a discussion, as needed.
And I think too, it was posted, I think Pete just posted it, but we also have our COVID matrix that we real-time update as states provide guidance if there's any sort of relief on all types of taxes. So payroll, withholding, corporate income, their gross receipts taxes. So any kind of COVID relief that a state has provided guidance on, or even a tax deadline being extended, that is all on our matrix. And as I said, it is continually updated as more states are coming out with guidance.
And I think the final point I'll make is, while we covered state pieces, we do our international group. I've had a number of clients ask about employees that are working in France or in other foreign countries. So that's a whole nother topic for discussion that just make sure that we're equipped to help on that, but it is another area of focus.
Okay, so thanks for completing our last polling question. The answer was A and B, gross receipts taxes and payroll taxes.
Yep. And I think, Alexa, the slides will go out, right? I think we posted the link, but the slides will go out to the attendees after this, or have it be accessible, correct?
That's correct.
Good. And I know that we've actually recorded the session too, right, Alexa, for those that couldn't make it and others that maybe want to, go through it again?
Yes, both the recording and slides will be available. Okay, so let's jump into some questions. We have a question from Janet. Said Washington State has certain tax exemptions for nonprofits related to revenue and income tax. Are there any exemptions for nonprofits related to the examples you provided?
Janet, good question. If the nonprofit is selling the services, then the apportionment factor would apply to the nonprofit. Nonprofits generally need to pay Washington B&O tax, and there are just very limited exemptions.
Great. We had a question from Kevin asking, what about vacations, say under a 1 month time?
Well, that vacations was in air quotes, so I'm not sure what Kevin's getting at there. I think that if someone is working remotely very temporarily, especially right now during COVID, it may not trigger nexus. But Kevin, I'm not quite sure what you are asking with that question. So Pete, if you had any thoughts, you could jump in.
I was same issue, but if it's truly a vacation, then you're not working there. So if there's no services being provided by anyone in that location, there shouldn't be any issue.
Okay. And I think our last question, Pete and Doug already responded to Claire. So I do believe we've taken care of all questions. As you said, Nancy, there will be slides and the recording of the presentation made available afterwards. And
please feel free to reach out to us after the webinar at any point in time if there are questions that come up down the road. Happy to help.
Right.
Well, good. I think that's it. Not too bad over our time allotment, but I appreciate everybody. Thank you to the panelists, and great topical discussions, and to those that attended. And we will look forward to hearing from you soon, and we'll having more sessions similar to this that are salient around tax and other matters. So thank you.
Yeah, thanks everyone.
Bye-bye.
Bye-bye.
Bye now.
Bye. Thank you.